$13.6 billion. That's what Tesla spent buying back its own stock between 2020 and 2024. And if you're holding tech megacaps expecting steady dividend-fueled growth, or worse, buried in index funds without knowing your exposure, this capital allocation crisis could derail your retirement by 2 to 3 years. Stick around because the numbers are about to get uncomfortable. Most investors believe Tesla's buyback program signals financial strength. Apple does it, Microsoft does it. It's supposed to look like a board confident in the future, returning cash to shareholders. But here's what the data actually shows. While Tesla spent $13.6 billion buying back stock, competitors were doing the opposite. Ford allocated $6.5 billion to manufacturing capacity and R&D. General Motors committed $7.2 billion. Volkswagen, euros 20 billion, roughly $22 billion, earmarked specifically for EV manufacturing infrastructure through 2027. Let me break down what this means for your retirement number. A household with $500,000 in Tesla exposure, whether you own it directly or it's buried in a tech-heavy index fund, could see an 8 to 15% total return compression if buyback-driven valuations weaken as competition accelerates. That's $40,000 to $150,000 in delayed wealth over 5 to 10 years. For someone planning to retire in 2027 or 2028, that's not theoretical. That's the difference between hitting your number and working 2 to 3 more years. That's real. Now let's look at the actual filing numbers, because this is where the crisis becomes undeniable. In 2023, Tesla's capital expenditure was roughly $1.8 billion. Buybacks that same year, $1.6 billion. That means Tesla spent 90% of what it allocated to competitive infrastructure on financial engineering instead. Now compare that to Ford, $6.5 billion in capex during 2023. Focused on EV production ramp, General Motors, $7.2 billion capex directed at battery plants and legacy vehicle transition. Volkswagen committed euros 20 billion through 2027, specifically for EV manufacturing capacity. The belief gap is absolutely stark. Tesla's management is returning capital to shareholders at the exact moment when competitive EV capacity is exploding globally. And here's the data that should keep you up at night. BYD's 2024 production guidance hit 3.02 million vehicles. Tesla, 1.8 million units. BYD is already outpacing Tesla by 68% in volume. Legacy OEM are bringing EV platforms online at scale. Yet Tesla's board approved a $25 billion buyback authorization in 2023, $25 billion, while capex guidance stayed flat at $1.8 to $2.3 billion annually. This inversion signals one thing: management either believes the stock is overvalued or growth capex needs are slowing. Either interpretation is a red flag for long-term returns. Historical research from Ned Davis Research shows that buyback cycles peak exactly when competitive pressures intensify. Why? Because boards authorize massive repurchase programs when they can't find productive uses for cash. Tesla's $13.6 billion cumulative buyback represents over 25% of annual capex during 2021 to 2024, precisely the years when the company should be defending market share against BYD, legacy OEM ramping EV production, and emerging EV brands scaling globally. The timing couldn't be worse. Let's quantify the damage. $500,000 Tesla position receiving 5 to 6% annual appreciation from buyback support, instead of 2 to 3% from operational growth, loses that 3% spread. That's $15,000 per year in a 2 to 3 year window as buyback effectiveness declines and competition compresses margins. Over a decade, that compounds to $45,000 to $75,000 in foregone wealth accumulation. For retirement planning, that's devastating. For dividend income investors targeting retirement in 3 to 5 years, this creates dangerous portfolio concentration risk. If Tesla's stock support weakens and you're forced to rebalance ahead of schedule, you're crystallizing losses into a down market or trimming winners at precisely the wrong time. The buyback trap works like this. It masks capital misallocation until suddenly it doesn't. And when the repricing hits, it's sudden and severe. Here's what makes this structural, not cyclical. Until management shifts capex spending to match competitive ratios, Ford and GM average 3 to 4% of revenue. Tesla is 5 to 2%. Buyback financed valuations will compress as margins tighten and growth slows. This isn't pessimism, it's mathematics. If your retirement strategy relies on megacap tech buyback stories, audit your Tesla exposure immediately. The window to trim or rebalance before competitive pressure accelerates is closing. The full implementation checklist is in the description. In strategy, the quiet observer wins.